In this chapter, the author introduces the concept of the big ugly event, the stock market crash of 1929 and the beginning of the Great Depression. The author emphasizes that while the stock market is a powerful wealth-building tool, it is also extremely volatile and crashes can cause significant losses. However, the author argues that if investors can toughen up, ride out the turbulence, and remain humble about their investing abilities, they can still achieve wealth through the stock market. The author presents several key points about the big ugly event. Firstly, they highlight that it would have taken exceptionally bad luck to have experienced the full weight of the crash, as the outcome would have varied depending. Secondly, the author suggests that a crash at the beginning of an investor's career can actually be a gift, as it provides opportunities to buy stocks at bargain prices. Thirdly, the author explains that while the crash may have caused a significant hit to a retiree's portfolio, the deflationary nature of the depression meant that the remaining funds had more buying power. The author also notes that the big ugly event has only occurred once in the last 115 years and argues that with the controls put in place since 1929, it is unlikely. They draw encouragement from the fact that in 2008, the economy came close to another major crash but managed to avoid it. However, the author warns that hyperinflation is another economic disaster that can destroy wealth on a major scale, and it is just as destructive as deflation. They explain that a little inflation is healthy for the economy, but when it spirals out of control, it can lead to a deadly cycle of increasingly worthless currency. The author concludes the chapter by highlighting that stocks are a good inflation hedge and that the decision every investor must make is how much risk they are willing to accept in the wealth-building process. They acknowledge that big ugly events are scary and destructive, but they are also rare and survivable. In the next few chapters, the author promises to discuss specific investments to build and protect wealth, emphasizing that the process is simpler than most people believe. Chapter 10 of the book emphasizes the importance of simplicity in investing. The author argues that complex investments are less likely to be profitable and can be costly. They also highlight the financial incentives for companies to promote complex investments. The chapter introduces three considerations for investors: their stage of investing life, their level of risk tolerance, and their investment horizon. The author advises readers to build their FU money, which is the financial freedom to withstand unexpected changes in employment. The chapter also challenges the idea of short-term investing and encourages a long-term perspective. The author then introduces three tools for building a portfolio: stocks VTSAX, bonds VBTLX, and cash. These tools serve as a wealth builder, inflation hedge, deflation hedge, and cover for daily expenses and emergencies. The chapter concludes by mentioning that readers can fine-tune their allocation in each investment based on their personal considerations. The upcoming chapters will delve into index funds, bonds, specific strategies, and selecting the best asset allocation. Overall, the chapter emphasizes the simplicity and effectiveness of the recommended investment approach. In this chapter, the author challenges the misconception that index funds are only for lazy investors. He introduces Jack Bogle, the founder of Fivingward and the creator of index funds, as a financial industry titan and investing saint. Bogle himself admits that he has never met anyone who can consistently beat the market, and the author agrees with this sentiment. The concept of indexing is based on the idea that buying all the stocks in a market index will outperform professional management, especially when considering costs. The author argues that trying to pick winning individual stocks is a false errand and that even the top-tier money managers often rely on luck rather than skill. Despite the evidence supporting indexing, many people resist the idea. The author suggests that this resistance may stem from the challenge of accepting that they can't outperform an index, the desire to be above average, the influence of financial media stories. The author personally chooses indexing because it is more effective and powerful in building wealth than other alternatives. They emphasize that indexing is not just easier or simpler, but it provides better returns. The chapter concludes with the advice to keep your feet firmly on the ground with indexing unless you are Warren Buffett.